Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Wednesday, May 31st, 2023. And welcome back to the Crypto Overnighter podcast, where we have no sponsors, no hidden agendas, and no BS. Dr. Saifedean Ammous, the author of the book The Bitcoin Standard, has been chosen as the economic advisor for El Salvador's National Bitcoin Office. The office made the announcement on May 30th, stating that Dr. Ammous would provide guidance on various economic policies. His book gained popularity after its publication in April 2018, and it examines the shift from stable stores of value to inflated assets in fiat currencies. It delves into the history of money and explores how monetary systems have influenced civilizations over time. Expressing his excitement about this new role, Dr. Ammous tweeted on May 30th, highlighting that he would be working in the very first country to adopt a Bitcoin standard. In an interview with a local media outlet, he emphasized the unique nature of Bitcoin as an asset that retains its value over time. Now, according to him, if money depreciates, there's little incentive to save, and it becomes more reasonable to accumulate debt. Dr. Ammous also expressed optimism about the future, stating that if Bitcoin continues to be accumulated over the next 5 years, there is a good chance that El Salvador could become debt-free. During his visit to El Salvador, the good doctor lectured students in a Bitcoin and Lightning Network developers program called Cubo Plus. The program aims to teach locals about coding and Bitcoin concepts. He also had a meeting with President Nayib Bukele where he discussed the significant advantages of economic liberty. The National Bitcoin Office mentioned that the doctor has declined any financial compensation for his advisory role and is solely interested in supporting President Bukele's Bitcoin policy. The office, established by President Bukele in November of 2022, is responsible for overseeing all crypto-related matters in El Salvador. In addition to Dr. Ammous, American broadcaster Max Keiser and television presenter Stacey Herbert are also part of President Bukele's Bitcoin team. Keiser acknowledged the influence of Dr. Ammous' book, stating that it has enlightened millions of individuals, including prominent figures like MicroStrategy founder Michael Saylor, who continues to add Bitcoin to their portfolios. From El Salvador's Bitcoin adoption, let's shift our focus to the global stage, where the United States' restrictive crypto policies could be playing into China's hands. China could benefit from the United States' restrictive cryptocurrency policies, at least according to Brian Armstrong, the CEO of Coinbase. He wrote an op-ed for MarketWatch, and he expressed his concern that labeling crypto as an unstable asset class could cause the United States to lose its financial leader and innovation hub position. He emphasized that crypto is a transformative technology with the power to revolutionize various sectors such as finance, supply chains, and social media. Armstrong highlighted the ability of crypto to facilitate royalties for secondary market transactions as an example. He urged policymakers to recognize the broader implications of crypto and to provide regulatory clarity to foster its potential while protecting consumers. Now, Coinbase, under Armstrong's leadership, has consistently advocated for clear regulations in the crypto industry. The company requested clarity from the SEC regarding the classification of digital assets as securities. They opposed the SEC's approach of regulation through enforcement. In response, SEC Chair Gary Gensler argues that existing securities regulations already apply to digital assets. Armstrong also noted that Hong Kong's positioning as a global crypto hub is unsurprising as China aims to challenge the United States' role as the global financial leader. China's recent launch of the digital yuan is seen as a direct challenge to the dominance of the US dollar in global commerce. Armstrong warns that if the United States fails to pass comprehensive crypto legislation, it would lag behind and require significant investment to regain its innovation capabilities. However, he cautioned that even with substantial effort, it may be too late to catch up. Armstrong's op-ed highlighted the unintentional consequence of restricted crypto rules in the United States, which could drive innovation offshore and could benefit China. He mentioned China's ambitious digital systems, including Alipay and Tencent payment systems. Despite China's previous ban on cryptocurrencies, there are signs of change, such as the release of a Web3 white paper promoting the industry's development. Hong Kong's Securities and Futures Commission has also released regulatory requirements for virtual asset trading. Now, Coinbase has been engaged in a prolonged dispute with the SEC regarding new crypto rules. In their public outreach efforts, they've run a TV ad in Washington, D.C., expressing concerns about national security implications if the crypto industry is not developed in the United States. Armstrong stressed the importance of American technology leadership and national security and warned that future generations could suffer the consequences if the U.S. falls short in the crypto industry. Now, while the U.S. grapples with its crypto policy, other nations are forging ahead. Let's turn our attention to Hong Kong and the UAE, who are partnering up to strengthen their cryptocurrency regulations. Now, we were just talking about Hong Kong a little bit ago. Well, Hong Kong and the United Arab Emirates, their central banks have agreed to collaborate on cryptocurrency regulations and financial technology development. The Hong Kong Monetary Authority announced that it had a meeting with the Central Bank of the United Arab Emirates, and they've decided to strengthen cooperation in virtual asset regulations and developments. They also aim to facilitate discussions on joint fintech development initiatives and to share knowledge through their respective innovation hubs. During this meeting, they discussed financial infrastructure and financial market connectivity between the two regions. The UAE's central bank governor is Khalid Mohammed Balema, and he expressed his expectation that the relationship with the HKMA will be ongoing and long-term. Now, the chief executive of the Monetary Authority is Eddie Hu, and he believes that collaboration will bring economic benefits to both jurisdictions as they have complementary strengths and mutual interests. Following the meeting, the two central banks organized a seminar for senior executives from banks in Hong Kong and the UAE. The seminar covered topics such as improving cross-border trade settlement and exploring how the UAE corporations can use Hong Kong's financial infrastructure platforms to access Asian and mainland markets. This collaboration comes as the Securities and Futures Commission of Hong Kong prepares to allow virtual asset service providers to serve retail investors in Hong Kong starting from June 1st. This move reflects Hong Kong's recognition that virtual assets are here to stay. Christopher Hui is Hong Kong's Treasury Chief, and he emphasized the fundamental value of virtual assets and stated that despite the potential risks involved, the benefits outweigh those risks. He highlighted the importance of regulation to harness the positive elements of virtual asset activities. Now, in response to the SFC's announcement, several cryptocurrency exchanges, including CoinEx, Huobi, and OKX, have filed applications to offer dedicated crypto trading services in Hong Kong. Now, as Hong Kong and the UAE strengthen their relationship, the UAE is also taking steps to tighten its anti-money laundering guidelines. Let's delve into the details. Now, we were just talking about the Central Bank of the UAE. Well, they've released new guidelines around anti-money laundering and terrorism financing measures for cryptocurrency businesses. This guidance highlights the risks of dealing with virtual assets and virtual asset service providers, considering the recommendations of the global watchdog, the Financial Action Task Force. These new rules will become effective in 1 month. The implementation of the guidelines will impact licensed financial institutions in the United Arab Emirates, such as banks, finance companies, exchange houses, payment service providers, registered Hawala providers, and insurance companies, agents, and brokers. Now, Governor Balema, we were just talking about him. He stated that the new guidance regarding the virtual asset sector will strengthen the central bank's supervisory and regulatory frameworks in combating money laundering and the financing of terrorism. He emphasized the continuous efforts to enhance the awareness of licensed financial institutions in preventing financial crimes and reducing potential risks. These measures aim to protect the financial and monetary system's stability and soundness, aligning with the standards set by the Financial Action Task Force. The issuance of this guidance coincides with the UAE's active endeavors to attract cryptocurrency businesses to the region, partly through a favorable regulatory framework. Boy, that would be nice. In March, Dubai introduced a new agency responsible for regulating virtual assets. Regulators in the region, including major crypto firms like Coinbase, have received praise for their approach in this regard. While the UAE is tightening its regulations, other countries are embracing the potential of blockchain technology. let's take a look at Japan, where the XDC network is expanding its presence. XDC network was previously known as Zinfin. They've expanded their presence in Japan through a partnership with SBI VC Trade. That's a subsidiary of SBI, which is a Tokyo-based financial holding company. This collaboration between the enterprise hybrid blockchain solution and the cryptocurrency exchange aims to enhance the trading experience for customers. So on May 31st, XDC Network announced its addition to SBI's crypto exchange subsidiary. Fumuki Ozaki is the CEO of SBI VC Trade. They expressed delight in expanding their cryptocurrency offerings by including XDC. The network brings a unique value proposition to the trade finance market. In March 2023, XDC token experienced significant growth as one of the top 5 altcoin gainers with a 54% increase in just 30 days. The XDC network supports smart contracts, protocols, and atomic cross-chain token transfers compatible with the Ethereum virtual machine. Additionally, it adheres to the ISO 20022 message standard, ensuring seamless electronic data interchange between financial institutions. To further decentralize the governance of the blockchain, XDC Network decided to establish a decentralized autonomous organization, a DAO. This community will have a say in distributing ecosystem funds to drive development. Atul Kekade is the co-founder of the XDC Network. They expressed excitement about the partnership with SBI VC Trade and bringing the XDC ecosystem to the Japanese market. The aim is to streamline the international trade sector by improving transparency, traceability, and reducing costs. SBI is actively increasing its presence in key crypto markets. It obtained a license to operate in Singapore in September of 2022. Moreover, one of its investees, Clear Markets, received approval from the US CFTC. From Japan's blockchain expansion, we move to India, where the central bank is encouraging banks to adopt AI and blockchain technology. A top federal officer representing India's central bank recommended that all banks adopt artificial intelligence and blockchain technology to ensure sustainable growth and stability. Deputy Governor Marish Kumar Jain discussed risk strategies around sustainable growth and stability at a conference organized by the Reserve Bank of India for Indian bank directors. Jain emphasized the importance of effective corporate governance and governance structure and processes in preparing for future risks. Technological disruptions, evolving customer expectations, and cybersecurity threats have introduced new sets of risks for banks across technology, business, and operations. Jain's advice for addressing these challenges was for banks to focus on tech adoption. Jain recommended that Indian banks, quote, adopt innovative technologies such as AI and blockchain to prepare for the future. He also emphasized the importance of digital transformation, enhancing customer service, and investing in cybersecurity measures. By embracing these strategies, banks can better navigate the changing landscape and mitigate potential risks. India's central bank digital currency was launched on November 1st and started being tested for offline functionality in March. The Reserve Bank of India intends to use its CDBC as a medium for exchange, further highlighting the country's focus on embracing digital technologies in the financial sector. In a similar vein, Pakistan announced its ambitious plan to train 1 million IT graduates on AI by 2027. The country aims to leverage AI in various sectors, including predicting the weather, optimizing the agriculture supply chain, and transforming healthcare services. This commitment to AI reflects the growing recognition of its potential to drive innovation and economic growth. Now, both Pakistan and India recognize the importance of embracing technological advancements such as AI and blockchain to enhance their banking systems and overall economic development. By harnessing the power of these technologies, they can navigate future risks, improve efficiency, and provide better services to their citizens. Now, while India is looking to the future with AI and blockchain, the US CFTC is issuing a warning about the risks associated with clearing digital asset transactions. So, the Commodity Futures Trading Commission cautioned companies about the risks associated with clearing digital asset transactions, and Commissioner Kristen Johnson has called for the advisory to be transformed into a comprehensive rule-writing effort. On Tuesday, the agency's Division of Clearing and Risk issued the advisory, stating that it would focus on the emerging risks in cryptocurrencies due to the increasing number of supervised entities clearing such trades. The risks highlighted include potential conflicts of interest, protection against cyber threats, and the management of the physical delivery of assets in transactions that require such delivery. The agency expects companies to proactively identify and address new, evolving, or unique risks by implementing risk mitigation measures tailored to those risks. Commissioner Kristen Johnson expressed her support for the agency's statement and urged the CFTC to initiate a formal process to establish new rules. She noted the growing registration activity for crypto commodity derivatives clearing and highlighted that certain proposed models adopt a non-intermediated market structure. Without parallel regulation, these models may not be subject to the most stringent regulatory standards. Now, several crypto firms, including LedgerX, have become derivatives clearing organizations under CFTC oversight. Now, LedgerX did attempt to establish direct crypto clearing without intermediaries, and that attempt was eventually abandoned. It did raise unresolved concerns. Johnson emphasized that the CFTC's advisory underscores the need for a rulemaking process to address the unique challenges of implementing customer protections in non-intermediated crypto markets. Public warnings issued by regulators about specific activities are often followed by sanctions in those areas. So, in the meantime, the CFTC has been actively pursuing enforcement actions against crypto companies, such as its recent action against Binance. As derivatives regulator, the CFTC directly oversees crypto futures and has enforcement authority over fraud and manipulation in spot markets for non-security crypto assets. It is expected to play a broader role as an agency watchdog, but bills that would enhance its authority have yet to progress through Congress. Now, as the CFTC issues its warnings in the US, let's turn our attention to Canada, where Bybit has decided to exit the market due to regulatory developments. Following the footsteps of Binance, Bybit has decided to leave the Canadian market due to regulatory developments. In a blog post on Tuesday, Bybit stated that it made the difficult but necessary decision to pause the availability of its products and services in compliance with relevant rules and regulations in Canada. The company cited the regulatory environment in the country as the reason for its departure, and it announced that it would stop accepting account opening applications from identified Canadian residents and existing nationals starting from May 31st. So, last December, the Canadian government introduced new requirements for crypto firms operating in the country. These requirements include keeping customer assets separated from company assets, which is fine, and utilizing a third-party custodian. The government implemented these rules in part because of the FTX collapse, where customer funds were allegedly used to cover losses in its sister company's balance sheet. Additionally, the Canadian Securities Administrators declared stablecoins as potential securities or derivatives similar to the stance of U.S. regulators. They also prohibited margin or leverage trading for Canadian clients. Firms were instructed to register and comply with these rules to continue their operations in Canada. Customers who were already using Bybit and are affected by the changes will no longer be able to make new deposits, enter into new contracts, or increase their current positions starting from July 31st. However, they will still have the option to withdraw funds and reduce their positions. Bybit advised Canadian customers impacted by these measures to take the necessary steps by September 30th, 2023 to wind down and manage their positions. Now, as mentioned, Binance previously announced its withdrawal from the Canadian market due to these new rules. The company stated that the new guidance regarding stablecoins and investor limits made the Canadian market unsustainable for Binance. They said that despite exploring other avenues to protect Canadians, it became evident that no viable options were available. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, subscribe, leave a rating or a review. And in the meantime, we'll see you tomorrow night.